Hey guys, welcome to today's video. Today I'm going to be going over the 10 stocks that I have on my watch list. I'm invested in 4 of these currently, and I am looking to invest into all 10 of them eventually as my portfolio grows. All 10 of these stocks are on my watch list, and I only have 10 on my watch list, so I'm going to showcase everyone that I am looking into investing in right now. So the first one here is Toronto Dominion Bank. You guys have all probably heard of this, and you guys know how good of a stock this is, and this is the biggest position in my portfolio at like 40% right now. It's not going to always be at 40% of my portfolio, but this is still going to probably remain the top position in my portfolio for many years to come, as I love this stock. It pays a 3.84% dividend yield, and right now it's a pretty good time to buy as a 9.7 PE ratio. You can't really go wrong with buying TD, no matter what price it is, in my opinion, though. Like, right now is a pretty low price, as we can see here. Let's go back to the 3-month, and it's been at 87 within the 3-month period. So it's at 82 right now. It might be a good time to get in, but even if it goes back up, I really don't see why not to invest in this company. I really believe in it long term. Coming in at second tier, these are not in any order, but this is just the way I have them on my list here. We have Algonquin Power and Utilities. I'm also invested in this company. They pay a 4.38% dividend yield, and they have a PE ratio of 13.6. Their stock price is $19.47, and they're in the utilities industry. The big reason I want to invest in them is because I believe in their renewable energy plan that they have put out. As Canada switches to more of a renewable energy plan in the future, I think this company is going to grow and grow. So that is another reason I do have money in their stock, is because I think they're going to grow, and I think that their dividend yield is very nice as well. Coming in at third here, we have Telus. I am also invested in this company. It is a telecommunication service company. Many of you have probably heard of Telus if you're from Canada. They pay a 4.32% dividend yield, and their stock price is just under $30 at $29.25. Right now, it might be a bit expensive to buy, but I still got in because I'm not really too focused on growth. I think they'll grow slowly over time regardless. Like, as you can see, the 5-year chart, they've been growing along with the market. So I really think that holding this company over the long term, which is what my strategy is going to pay really good dividends and growth. And overall, I think it's a great company to be invested in for the long term. The fourth company I am invested in is Manulife Financial Corporation. They are in the insurance industry. Their stock price is $24.44, paying a 4.58% dividend yield, which is a very, very nice one. And their PE ratio, this is what really stands out to me. It is 6.70, which is exceptional. Like, that is one of the lowest I've ever seen. And I don't really judge too much off PE ratio too much, but this company, we look at their 5-year chart, and they haven't been growing too much, but it was at $13, and I think this company, really, the sky is the limit. They're growing pretty rapidly, and I think it's going to continue that way. So I really, really am going to increase my position in this company as well in the upcoming months. Coming in at number 5, we have Enbridge, ENB. They're in the oil and gas industry. Their share price is $50.47. They're paying a 6.6 dividend yield right now, which is obviously amazing. I really don't, I'm not going to get into this company. I don't own this company yet, but I am going to get into it just because of this dividend yield. If I can maintain anything above 5, I'd be really happy. I'm just going to hold on to the stock for years because, my strategy is to generate as much passive income off dividends as possible. And hopefully, since I'm only 18, I'm hoping that one day maybe I'll have enough money coming in every month off dividends. I won't have to work. Like, obviously, it's a far, far away goal, but I think it is doable if I just keep on starting early and investing my TFSA limit every single year. Next up on the list is Smart Centers, ticker SRU.UN. It is a REIT, a real estate investment trust. Right now, the share price is at $30.24. And another thing I want to point out about this stock is that it is a monthly, so they pay monthly dividends. So they'll pay dividends 12 times per year, every single month, which is nice because I like having a couple of these in my portfolio just because I know I'm going to get paid every single month. Like, let's say I didn't have any monthly paying dividends in here. There would be some months where I might not get dividends at all if I only have a couple of positions. So I do like to have at least one or two that do pay monthly dividends. They do also pay a dividend yield of 6.1%. That fluctuates quite a bit, but it's usually up around in that range. And I really, really, just like the same reason as Enbridge, really, that dividend yield is going to help give me as much passive income as possible, especially since this company pays it every month. Coming in next is a classic stock here. We have CN Rail. I'm going to look into getting into this company shortly. They're in the transportation industry. They don't pay too high of a dividend yield. It's only 1.632%, but they've been increasing that for a very, very long time, and I think they're going to continue to do it. It's a pretty expensive stock, $150 for one share, but it really isn't like that bad when you look at the PE ratio. They pay quarterly dividends, and I really, really think if you hold this stock for a long time, you'll be fine. It will perform pretty well. This is not financial advice by any means. Let's get that out of the way. But again, this is another great long-term stock, as I believe all these ones that I have on the list are. Another one that I'm not going to get into it anytime soon, I don't think, which I might get a couple of shares here and there, but it is a retail defensive industry. It is a Circle K or Alimentation Couche-Tard. They own Max or Couche-Tard if you're in Quebec, I believe, but they own a couple of gas station companies and things like that. And the dividend yield is only 0.7%, but I know their payout ratio is pretty low. I'm not too sure what it is, but I think it's like around 10% or something like that, something really, really low. So they can definitely increase that, which would mean the dividend yield would go up in the future. Their PE ratio is not terrible by any means at 16.4, and their share price is at around $50. So I definitely, like, if you look at the last year chart, this stock has been growing like crazy. Like it really is insane, and I think this company is going to keep on growing. So I'm probably going to get in within the upcoming couple months, like 6 months or so. I'll get on this stock. The reason I can't really get in right now is because I can't invest in too many companies because of my TFSA contribution room. I'm only 18, so I can only invest $6,000 this year. But in January, we'll see if they raise the contribution limit again. They're probably going to make it at least $6,000 again, in which case I'll be able to invest in this position and a couple others here on the list. Second to last here, we have Amera Incorporated. It is another utilities company similar to Algonquin. They pay a quarterly dividend at a 4.30% dividend yield. The share price is $59.19, and I do believe that they're going to switch to renewable, being as renewable as possible, and also getting rid of, the old-fashioned way like coal and stuff like that. They're trying to switch to a more eco-friendly way, which is the direction Canada is headed. So I do believe this company will succeed for the long term. And again, they pay a great dividend. So this is another great stock for growth and dividends. Coming in at the last stock here, we have another monthly dividend payer, another REIT. It's Ryokan Real Estate Investment Trust. I was deciding between Granite, which is another real estate investment trust, and this one. I really couldn't decide, so I just kind of picked Ryokan because it was the one on my watch list. But they pay monthly dividends, a 4.27% dividend yield, so it's not as high as a dividend yield as Smart Center is, but the PE ratio is 16.30, and this is another REIT that is really popular in Canada, and I really think will be a pretty good long-term play. I'm not really too focused on growth here. It's just another nice monthly dividend payer here in the portfolio, so that is why I'm going to invest in it in the future. Anyways, thanks for watching, guys. If you want two free stocks, there's a link in the description to Wealthsimple Trade. Make sure to check that out. If you do not have a Wealthsimple Trade account, you get free commission stock trading. You can't really beat that right anywhere else right now in Canada. It's probably the best platform in my opinion. Anyways, thanks for watching. Stay tuned. Subscribe with notifications on to be alerted every time I post a new video. Thanks for watching. Peace.